Welcome back, students, to Intermediate Accounting. And in Chapter 4, we're going to take up a brief review, actually rather extensive review, of the accounting cycle. The accounting cycle describes the process by which companies record business transactions in their books, which they ultimately aggregate and summarize in the financial statements. We begin with transaction analysis, and including the use of the general accounting equation. By the way, all of these are very similar between GAAP and IFRS practices, with two exceptions a little later on that I will note. A transaction is an economic event that involves a change in an asset, a liability, or a stockholder's equity, the three types of accounts. The accounting equation assesses the effects of transactions on assets, liabilities, or stockholders' equity. And we express this in a general formula: assets equal liabilities plus stockholders' equity. The expanded accounting equation includes income statement items and dividends. So assets equal liabilities plus contributed capital plus accumulated other comprehensive income plus beginning retained earnings minus dividends declared plus revenues and gains minus expenses and losses. The double entry system is one in which all the transactions affect at least two accounts, and the accounting equation always holds. That is, the debits and credits are always equal. Next, we look at journalizing transactions, and included here, determining whether to debit or credit an account. Journalizing a transaction involves preparing a journal entry. The common format includes the following: A, the date of the transaction, which is in the first column. B, accounts that are debited first and posited and positioned on the left side. C, accounts that are credited are recorded next and indented slightly to the right. And then possibly a brief explanation below the entry, because as time passes, it's no longer clear what the transaction may have involved, as if we had written it down at the beginning. An account is an individual record of increases and decreases in a specific asset, liability, or equity item. The terms debit and credit mean left side and right side. Assets increase with a debit and decrease with a credit. Liability and equity accounts increase with a credit and decrease with a debit. Revenues and gains are increases in equity. These accounts will then increase with a credit. Expenses and losses decrease equity, so they increase with a debit. Similarly, dividends decrease equity, so they increase with debits as well. The normal balance of an account refers to the typical account balance, debit or credit. Again, all of this is similar under GAAP and IFRS practice. Next, we turn to an explanation of the importance of and how to post transactions to the general ledger. So after we've entered them in the book of original entry in the journal, we will transfer that data to the summary of accounts, or to the ledger of accounts rather, which include all the individual items, each with its own record. Posting describes transferring this information contained in the journal to the individual ledger accounts. The general ledger contains all accounts maintained by the company, with each account reflecting its increases, decreases, and balance in a single location for management analysis. The general ledger has a column for the date, explanation, reference, debit, credit, and balance. The reference is the general journal page number where the original entry occurred. T accounts are used to depict the account. They have three main parts: the account title, the left side, debit, and the right side, credit. Next, we turn our attention to the importance of preparing an unadjusted trial balance. A trial balance is just a listing of the accounts and their debit or credit balances at any point in time. The balance sheet accounts are listed first: assets, liabilities, and equity, followed by dividends and the income statement accounts, revenues, expenses, gains, and losses. The trial balance provides a check on the recording process by ensuring the equity of debits and credits, or the equality of debits and credits. The trial balance does not prove the accuracy of the recording process and will not reveal if the following mistakes have taken place. A transaction has not been journalized, or it won't reveal if a correct journal entry is not posted. Again, an entry is posted twice, won't be disclosed. Fourth, an incorrect account was used. That will not be exposed. And finally, an entry is made using incorrect dollar amounts. Again, that trial balance will not reveal this. The unadjusted trial balance may not reflect all of the events and circumstances of the company because the adjusting journal entries have not been made at the time that the unadjusted trial balance is completed. So having taken this step in the closing cycle, or the accounting cycle, we next turn to the need for adjusting entries and explain deferrals and accruals. Companies record adjusting journal entries, called AJEs, at the end of each accounting period to ensure that the financial statements are presented under the accrual basis of accounting. Deferral AJEs occur when cash is received or paid before the revenue or expense is recognized in the financial statements. A deferred expense occurs when a cash payment is made before an expense should be appropriately recognized in the financial statements under the accrual basis. A deferred revenue occurs when cash is received before revenue should be appropriately recognized in the statements under the accrual basis again. Accrual AJEs are created when the economic event that gives rise to an accrual basis revenue or expense occurs before the cash is either received or paid, in other words, before the cash flows. Accrual revenues occur when revenues have been earned but cash has not been received. Accrued expenses occur when expenses have been incurred but cash has not been paid out. All of these practices are, again, similar under both the International and American Standard. Next, we turn to an explanation of the use of the preparation of an adjusted trial balance. All an adjusted trial balance is a reflection of all the events and circumstances of the company after it makes the adjusting entries, and it is a check to see that the amount of debits equals the amount of credits. Now we discuss preparation of the financial statements from the adjusted trial balance. There are differences in these financial statements from the balance between the U.S. and the international practice. Differences in the income statement will be described in the next chapter, Chapter 5, and differences in the balance sheet will be covered in Chapter 6. From the account balances in the adjusted trial balance, the company can prepare then the financial statements. This has all the data and it has been brought up to date. The income statement is prepared first using the revenue gains, losses, and expense accounts. This is because the net income or loss will be used in preparing additional reports. So we'll start with the income statement. The resulting net income for the period, along with the equity accounts, are used to prepare the statement of stockholders' equity. The balance sheet is then prepared by including all assets, liabilities, common stock, and the ending retained earnings balance obtained from the statement of stockholders' equity. So you see that last goes through several transformations. It goes from bottom line of the income account to the stockholders' equity under the form of retained earnings, and then into the final balance sheet. Next, we turn our attention to the difference between permanent and temporary accounts, and we demonstrate the process of closing the temporary accounts. Income statement accounts and dividends are temporary. These accounts must be reduced to a zero balance at the end of each period, very much as you might use the trip meter in your car to reset the mileage between filling the gas tank. Closing is the process of zeroing out temporary accounts. In addition to all the income statement accounts, dividends are also temporary and must be closed. Permanent accounts are on the balance sheet. Permanent accounts are not closed at the end of the period, and they carry forward from year to year, each accounting cycle, each accounting year. 4 entries are required to close the temporary accounts. We begin by closing out the revenue accounts. We debit each revenue account and credit an account titled Income Summary, so that the balance of all revenue will be included in that account. Then we close out the expense accounts. We debit the income summary for the total expenses and credit each expense for its balance so that it is again set to 0. Close out the income summary account. Next, we debit the income summary and credit retained earnings for the amount of net income. Or, conversely, we credit the income summary and debit retained earnings for any net loss. And step 4, we close out the dividends account by debiting retained earnings and crediting dividends for the period. The income summary account facilitates the closing process and is not included in the financial statements. It's a useful tool that's only used once a year. Lastly, we turn to the importance of preparation of a post-closing trial balance. After all closing entries have been journalized and posted, another trial balance proves the equality of the debits and credits. The trial balance contains only permanent, namely balance sheet accounts, because all temporary accounts were closed out before preparation of the post-closing trial balance and will have 0 balances. Again, this practice is the same in international and U.S. practice. That summarizes the chapter, a recount of the accounting cycle, something that you are already somewhat familiar with and now have a much keener and deeper understanding of the reasons why and the overall activity. Well, we'll continue on next week with income statement and the following week with balance sheet. Happy studying.